Good morning, everybody. Monday, November 11th, 2024. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. You can find me intra-week if we've got something to say on LinkedIn, Herb Morgan, or on X at Herb W. Morgan. Presentation is prepared by me for use with you, whether you are a financial advisor or an individual investor. Either way, you're expected to make your own investment decisions. Nothing contained in this presentation is investment advice, tax advice, a recommendation for the purchase or sale of any security. The opinions expressed herein are my opinions. They may differ from the views of our parent company, our affiliates, or even other portfolio managers at CFIA. Well, we had an election last week. We had a sweep, a red sweep, a Republican sweep. Donald Trump was reelected. The Senate will be in the hands of the Republican Party, and it appears there's a sweep. It appears the House of Representatives will also be in the hands of the Republican Party. Since they are seen as more pro-growth and lower regulatory burden, and there were campaign promises of lower tax rates, it sent stocks significantly higher last week. Look at the small cap 600 index, up 8.5%. Doubling its return for the year, now 16% for the year out of small cap stocks, mid cap up 20, large cap up 27, international emerging markets all participated. Interestingly, we had run up to well over 440 on the US 10-year. That backed down a little bit, giving us positive return from the 20-year Treasury Index and about 0.75% return on the US Ag, the Bloomberg Aggregate Bond Index. High yield caught a bid, strong bid, really there, up 80 basis points. Now over 8% on a year-to-date basis. Getting into economic data last week, the economic data really took a second position, a back seat, if you will, to the presidential election and the Fed meeting. Don't forget about that. Factory orders fell 0.5% in September after an 0.8% fall in August. Back-to-back negative months is not uncommon in this highly volatile series, so I don't really see this as much of a big deal. The balance of trade or trade deficit really widened out. Look at that. Now, see that over here on the right? Look at that. That's $84 billion. Now, when you run a trade deficit, that's a subtraction from GDP. So we subtracted about $84 billion from GDP in the month of September. Why? Because imports were up about 3%. Exports fell 1.2%. That widened out that gap. Part of this reflects the fact that companies were stockpiling ahead of a dock worker strike, which has now been resolved, but they're also stockpiling ahead of the holiday shopping season. They're stockpiling retail items. So it's a big gap there. We find that we got the final readings for October for the services PMIs from both S&P Global and ISM. The folks at S&P had the sixth consecutive month in this 55 range. We came in right at 55. The estimate was 55.3. Anything above 50 says the services sector, which is about 85% of the U.S. economy, expanded. That reading was confirmed by the Institute for Supply Management in their reading. They said it came in at 56. Estimate there of 53.8. That's the highest reading since July of 22. Hardly looks like an economy that is slowing down, starting to have job losses, anything that would sort of justify, rate cuts, this worry of job losses. In fact, it does look like inflation may be re-accelerating. We saw employment here, by the way, rise above 50 to 53. That was certainly welcome. And initial weekly claims for unemployment remain incredibly low. This is fantastic news. 221,000 last week in an economy with 350 million people and about 165 million people in the labor force. That's just a great, very low number. Continuing claims at 1.89 million. Non-farm productivity for the third quarter up 2.2%. Unit labor costs are up 3.4% year over year. Labor costs being really the largest input to production, generally speaking, for most industries, which obviously gives upward pressure to inflationary forces. Consumer credit was expected to come in up 12 billion. Didn't come in much. Came up 6 billion after a 7.6, pretty small number in August. Revolving credit, which you can see dropped in August, actually rose, but just barely, about $1 billion there. So credit growth may be slowing down. Doesn't really look like it, just a little bit. Consumer sentiment from the University of Michigan, which slowly coming out of the bottom doldrums since the summer of 22 through the summer of 2024, and then 5 consecutive monthly increases. Came in at 73. That was above the estimate of 71. Still, 30 points below where we were prior to the beginning of the COVID, pandemic and the related shutdowns. Okay. Big news on the week was the FOMC meeting, Federal Open Market Committee. They cut the Fed funds target rate, the upper bound, from 5 down to 4 3/4, and updated their statement. Here's the graph. This is a 5-year graph, right? This is all the hikes to try to fight inflation. Pause for a period of time. We dropped 50 bips in September, 25 bips here in November. In the statement they put out, they said that economic activity continued to expand at a solid pace. Labor market conditions have generally eased. That was a switch. The prior month they said labor market conditions have slowed. Inflation has made progress. Last month they said it had made further progress. So they said maybe it stalled for a month. That's another way of saying that. They removed has gained greater confidence that inflation is moving towards 2%. I can't overestimate how big of a deal that is. They had that language in the prior meeting. They said, we're confident inflation is moving towards 2%. It's not at 2%, and they removed the language. Very significant. And they finally said the risk to achieving employment inflation goals are roughly in balance. Okay, sure. Inflation expectations, though, the market, people making big capital bets, if you will, on where inflation is going to be over the next 5 years. Early September, before the Fed started cutting rates, we were down at 1.9% inflation expectations for 5 years. Now 5-year inflation expectations are at 2.4%. That's significantly above the Fed's inflation target. Other asset classes that are known as good inflation hedges. Let's start with gold. Gold here, looks like $2,000 an ounce a year ago, now at $2,600, right? That's about a 30% move in gold. And Bitcoin, right? Fixed supply, ultimately a fixed supply entity. A year ago, well below 40,000, now up here close to 90,000. And another great place to be with inflation is stocks, right? They raise the price of everything they make because they can, and pass those costs on to the consumers. And so stocks can be a very good hedge against inflation. Obviously, from a year ago, the S&P 500 at 4,400, now at 6,000 on the S&P. And the RSI, the 14-day relative strength index, which you can see here, it's not a perfect indicator, but it's a good one. When it gets high here at about 70, which is right where it is, you tend to have a little bit of a pullback. There's another time here, it's a little bit above 70 and a nice pullback in the index itself. So technically speaking, I think there's you can make a pretty compelling argument that we're about to get some kind of a pullback. And the other reason, of course, is just valuation. I showed you this the last couple of weeks, but it's worth watching until really something changes. 10-year U.S. Treasury, risk-free, 10 years, 4.3% on your money. And earnings yield of the S&P 500, 3.65. That's a very low earnings yield, very, very low earnings yield. And when your risk-free yield is at 4.30, I would think that these two lines would come closer together, and then ultimately you should get paid more for the risky asset. So either bonds are due for a real rally, or maybe we get a short-term correction in equity prices. And I said, well, gosh, what's happened? Cantor, we looked at this as a firm. So what happens when you're up big for the year through November 8th? And what happens the rest of the year? Well, going back to 1954, there have been 17 instances where we were up more than 17% through November 8th. and the average move into year end is about 4.3%. So hard to bet against a market that has this kind of momentum, but it is very prudent and reasonable, as I've been saying for several weeks, to make sure you're in the right risk allocation, because when markets correct, the equity piece of the portfolio is likely to be the one that goes down the most. We're wrapping up earnings season. 453 of 500 names have reported. 339 of those have beat the estimate of the analysts on Wall Street. 85 have failed to meet the estimate of the analyst on Wall Street. And the average beat was almost 7%. That's a pretty healthy earnings quarter. And that's one of the reasons valuations are so high, by the way. The earnings expectations, the earnings growth expectations for the consensus of the analysts on the street for both small and large cap stocks is close to 30% for the next year. So that sort of justifies that high multiple and that low earnings yield. Today is, in the U.S., Veterans Day. Thank you to all of the veterans who keep us safe, give us our freedom, allow us to enjoy our beautiful financial capital markets. Tuesday, small business optimism, and then 2 inflation readings on Wednesday and Thursday, CPI and PPI. Look at the year-over-year consensus estimate that CPI inflation, this is non-core, just regular headline, is going to go from 2.4 to 2.6. So that's an acceleration. And the year-over-year number from the producer price index, 1.8 up to 2.3. So this is difficult news for the Federal Reserve to hear, like, hey, we're cutting rates. And it's interesting that while they're doing that, they're not saying anything about the deficit, the fiscal deficits of the United States and the way in which they contribute to the inflationary pressure. Interestingly, on the same day we cut rates, and we have this bad inflation data coming presumably this week, the Bank of England cut rates on the same day last week. But the Bank of England's governors said unequivocally to their legislative branch, to their spending branch, hey, you got to knock off these deficits because we can't really control. We can control interest rates and we can help with inflation, but just because we're helping and doing what we're doing with rates or with the balance sheet, if you keep running, in this case of the U.S., 6.5%, 7% fiscal deficits, there's no way we'll be able to get the inflation numbers you want. There's no way we'll be able to get the inflation numbers under control. Okay, don't forget, you can hear us every week on any podcast format. The name of the program is Slaying Bulls and Bears. I try to make the complex and complicated simple and sensical. This is available on every podcast format, but the best place to view it is on YouTube because you get to see these wonderful graphs and charts. Thanks, everybody. I'll be back to you again in 1 week.